Okay. Thank you everyone for coming to the current conditions in the economy today. We have Mike Ferman, who always delivers excellent programs for us and is our economic expert. He is the former partner at Rubin Brown Advisors and the founder and managing director of its financial planning and investment advisory practice. I feel like every time we schedule this program, there's a ton of new stuff going on. So, Mike, I'm going to hand it off to you now.
Oh, thank you. Thank you very much, Daniel. Welcome, everybody. Just to kind of remind everybody of our format, we kind of set this up as a discussion. So I have a few minutes of kind of opening remarks, and then we'll kind of throw it open to the floor. And anybody with opinions or questions, please raise your hand, and we'll call on you, and we'll try to talk about your specific question or issue, or let you make your comment or statement. And just a reminder, we're being recorded, so we all have to watch our language, okay? we have to be very respectful of one another. For the past, I guess, several meetings, we've kind of talked about this tug of war that's going on for those investors that think there's going to be a soft landing, and those investors that think we're going to have a hard landing. And it continues to go back and forth depending upon, what series of data comes out. Why is this happening? Why is it so hard, okay, for economists and investors to kind of figure out where the economy and the markets are going? And I think it's important to maybe step back for a minute and kind of get a little context about what's been going on. Remember, during COVID, we had massive amounts of stimulus that the federal government poured into the economy, over $6 trillion of money, and a lot of that money is still not fully spent yet, okay, and has been kind of, it's an unprecedented event, and that's caused a lot of distortions and anomalies in the economy. Plus, the Federal Reserve only started raising interest rates a little over a year ago. Their first rate increase was only 25 basis points in March of last year. And their first 75 basis point increase was only a year ago in June. So most of the increases in the Fed funds rate haven't been fully reflected yet in the economy, because it takes 9 to 12 months for those rate increases to have the impact on the economy. So there's a lag time. And so we've kind of seen these things kind of creep in. We still have lingering effects from all the stimulus. And remember, the spending from the infrastructure bill and the CHIPS Act and some of these other bills that were passed last year are only now starting to get spent and get reflected in the economy. And again, we're still waiting to see what the impact of all the Fed rate increases have been. As we speak right now, the Fed is meeting for its June meeting. Everybody expects that this month they will pause and not raise rates, and then kind of take a wait and see attitude, and kind of monitor the data as it continues to come in. They've raised interest rates 500 basis points, 5%. The Fed funds target rate now is between 5 and 5.25. And if you recall from their last meeting, on their dot plot, which is the expectations of where they think the terminal rate's going to be, we are there. They thought the terminal rate where they would kind of end their rate increases was somewhere between 5 and 5.25%. Now, at the meeting that's going on right now, they're going to revise all their economic forecasts. They'll revise that dot plot, and then we'll kind of see what comes out tomorrow afternoon. Again, the expectation is they won't do anything this meeting. They'll kind of pause and gather some more data, and then figure out what it is they want to do, and give them a little more time to reflect on what the impact of all the stimulus has been, and what the impact of all the rate increases have been. That's why it's been so difficult this time for investors and market participants to kind of figure out what's going on, and we have this constant tug of war. Let's kind of review some of the more significant economic and market data that's occurred since we last talked a couple of months ago, and I think kind of give you an idea of there's plenty of data to support both camps, okay? Both those that think we're gonna have a hard landing and those that think we may have a soft landing. So let's kind of look at some of the good stuff. Obviously, the jobs reports have been much stronger than everybody expected. The last jobs report that came out just a week or 10 days ago, May jobs are up 339,000. That's really very strong. The unemployment rate did tick up a little bit to 3.7%, but wages are also up 4.3%, which is good if you're working, but if you're the Fed trying to control inflation, that's a little bit problematic. The job openings, there are 1.8 jobs available for every person looking. So the jobs market is still very strong. And that's good because it bolsters the bulls case. They're going to have a soft landing, but it makes the Fed's job a little bit harder because wages are going up and people have to pay more to attract people. So that makes things a little more problematic for the Fed. Weekly jobless claims number that, the one that came out recently, that's still under 300,000, which is good. They've been ticking up the past few weeks, which maybe it says maybe the labor market's getting a little tighter, but the weekly jobless claims under 300,000 is, it's not horrible, okay? So that gives a lot of support to the bulls case. In addition, the CPI numbers, you heard the number this morning was 4%. Now that was down from 4.9% last month, and it's been trending down. So the trend is good, and that's what the Fed wants to see, but 4% is still too high. And the core number, which excludes things like food and gasoline, was up 5.3%. So that's problematic for the Fed. It's good that inflation's coming down, but it's still far too high. And remember, these CPI numbers that we're getting are just kind of measure the rate of change between one year and another. Prices are not dropping, they're just not going up as fast. Remember this time last year, the CPI number was like 10%. So think about it. When prices are up 10% last year, so far this year, they're up 4%. 10 plus 4 is 4. That's a lot. Okay, that's a lot. And we all know this because we all go to the store and buy stuff, right? So inflation is tough. The rate is dropping, but it's still far too high, and it seems kind of sticky, and that's what the Fed's worried about. So that's why they want to take a little more time and see what impact all these rate increases they've had are having. Let's see. Fortunately, the debt ceiling issue had been resolved without a lot of trauma. There was some drama, but not nearly as much as what happened in 2011. But I kind of remind everybody that while this debt ceiling discussion was going on, two rating agencies, Fitch and Moody's, put the Treasury's or the U.S.'s credit rating on watch, negative watch, because of the drama and the vitriol in our political system, and the possibility that at some point somebody may get mad enough to let the U.S. default on its debt. So that we're on negative credit watch. And remember, in 2011, S&P, while they had the debate about the debt ceiling in 2011, S&P put the U.S. on negative credit watch. And then 2 weeks after they resolved the deal and got it signed, they downgraded the U.S. debt. So S&P still has the U.S. debt at AA+, not AAA. Fitch and Moody's are currently at AAA, but we're on negative watch. And this debt ceiling debate causes anxiety in the financial markets, okay? And there's nothing that says they can't down, even though they did a deal, doesn't mean they can't downgrade the U.S.'s debt at some time in the future. So they have to pay attention to that. But it obviously creates a lot of anxiety. Fortunately, they got this one done. We don't have to worry about it again until 2025. We'll see. Let's see what else here. Oh, interesting. Again, there's still a lot of future spending that's coming from some of these bills that were passed. Remember, the infrastructure bill was almost $1 trillion. And the CHIPS bill was another 300 billion. So there's a lot more spending that's coming down the road, which is going to help the economy grow, but it's also going to potentially create more inflation pressure and make the Fed's job a little harder. So we got to see what the impact of that is as well. Recently, the World Bank raised its global economic forecast for this year up to 2.1%, based primarily on the resilience of the U.S. economy. Europe is in, they've had 2 negative quarters in a row of GDP growth. China's reopening has been much slower than everybody thought. As a matter of fact, I think it was this week, China announced another stimulus package, and you've seen all the material stocks and oil stocks bounce up a lot today with the announcement of the new Chinese stimulus package, because their reopening has been going a lot slower than they originally thought. So, but that's a positive. And I guess also a positive is that oil prices have been dropping. Demand has been dropping primarily again because of China. Saudi Arabia, I think this past week, lowered their production. They made another production cut of 1 million barrels a day. That goes along with the production cut of 1 million barrels a day they did in May. And the primary reason we had a 4% CPI number is because of falling oil prices. But if China is going to re-stimulate, then their demand for oil should go up. And then with restrictions on supply, maybe the price of oil will go up, which could be problematic. Why is the price of oil dropping? It's because the sanctions on Russia haven't been working too well. Russia is pumping tons and tons of oil, and they're selling it to the Indians and the Chinese at very discounted rates. So that's been it's not been good for oil prices, but it's been good for inflation. But that could turn around with Chinese stimulus and with the production cuts that the OPEC is making. We'll see if they stick to them or not. Clearly, the Russians aren't, and for good reason. They need the money to fight the war in Ukraine. On the negative side, again, we have the money supply, N2, which we've talked about in the past. The money supply is down 4.6% year over year. Any time in the past, you look at history, if the money supply is contracted by more than 2%, we've gone into a recession. We're now at negative 4.6% year over year. It hasn't been more than 2% negative since 1933. This is, again, unprecedented. But remember, in 2020 and 2021, they increased the money supply 42%. So a decline of 4.6% shouldn't be too surprising given the Fed is doing quantitative tightening. But it's interesting, the money supply is contracting, and that could be a negative for economics. We had the little mini financial crisis with some of the regional banks. Bank lending, what they call C&I loans, commercial and industrial loans, they're down about 1.8% since the beginning of the year. Again, the Fed is worried that the regional banks will pull back on lending, which would slow down the economy. It'll help the inflation problem, but it will slow down economic growth. But that's a potential negative that the bears point to, is that, commercial lending, especially to small and medium-sized businesses, will slow down, and there'll be less capital for them to grow. So that's on the net. That's in the bears case. Okay. Let's see what else. Let's see. Now, the S&P 500 earnings estimates for this year, for 2023, are $220 a share. Last year, for 2022, S&P earnings were $218 a share. So earnings estimates have gone up this year. And for next year, analysts' operating earnings estimates are $246 a share. That puts the PE on 2023 earnings at 19.5 on the S&P 500, and the forward PE multiple on 2024 earnings at 17.6. The 25-year historical average is 15.5. So stock prices are not cheap. Okay. We'll see what happens. S&P 500 companies that reported in the first quarter beat expectations, but their earnings were down 1.3%. But you say, oh, that's bad. But the expectation was they'd be down 6.5. Now, the expectation for the second quarter is that S&P 500 earnings will be down 8%. So you kind of scratch your head and say, why is the market up? Because remember, markets are forward looking. And this is in June is the time of the year where investors start looking to 2024 earnings. And the analysts have 2024 earnings at $246 a share. So kind of think about it. Analyst estimates for next year are $246 a share because they see growth picking up again in 2024. That's the bull case. The bears think we're going to have a recession at the end of this year going into 2024. So how can the analysts have $246 of earnings? They're kind of scratching their head, say this doesn't make sense. So they think the market should go down. But this is the tug of war that we have been dealing with because the economic data is so uncertain, and what's happening in the economy is so uncertain. You have pockets of strength and you have pockets of weakness. The gross domestic product, GDP, came in at the first quarter at 1.3%. The Atlanta Fed has an estimate based on data as of last week. Estimate for the second quarter is that growth will be up 2.3% here in the US. So the economy has been pretty resilient. So that supports the bull's case. But you kind of get the picture. There's a lot of yin and yang. There's a lot of data that supports the bull case, a lot of data that supports the bear case. And again, the Fed doesn't know what's going to happen. And that's why they're going to pause probably tomorrow and watch and wait to see to determine what they might do. They may raise rates further. Okay, that doesn't mean they're going to stop. It doesn't mean they're going to lower rates because they've said in their meetings multiple times, we do not expect any drop in the Fed funds rate until the second quarter of next year. Now the market now is kind of in line with that. But again, nobody knows. Everybody is data dependent. But the market's yin and yang. The markets have been strong recently because the debt ceiling deal got passed. The jobs number was really strong, and China's reporting stimulus. So the market's been very positive lately. But next week, a new set of data could come out, and the bears will take charge again. Let's see. Kind of looking at the markets themselves. And as of May 31, this is data from S&P. U.S. aggregate bonds are up 2% year to date. Commodities were down 10%. No surprise there. International stocks were up 6%, and U.S. stocks were up 9%. If you look at the best and worst performing sectors, the sectors that have done best this year: information technology, no surprise there. Consumer services, communication services, and consumer discretionary. Stocks up 20%. The worst performing sectors: energy down 9%, utilities down 8%, financials down 5%. Everything that did well last year is down this year. Okay. And it's interesting, the S&P 500 was up 11.5%, and it's been primarily driven by 7 big tech stocks. Okay, the market performance has been very narrow. Now, in the last week or 10 days, it's starting to broaden out a little bit, which is a good thing. That's what you'd want to have happen. But most of the performance is concentrated in 7 big technology stocks, kind of all focused with this artificial intelligence. Artificial intelligence is kind of a new cool concept, but yet nobody's made a whole lot of money on it yet. So, but there's a lot of hype, and it maybe has a lot of potential, but it's driven up the prices of a lot of these stocks like Nvidia and Microsoft and Alphabet and, you know, the usual suspects. That's where most of the performance has come from. So market has to broaden out a little bit if the rally is sustainable. We'll see. Let's see here. So what do you? Well, this is all great. So what do? You know, given that both the bull case and the bear case have a lot of data to support their positions, I think it's important to be diversified again across all the different asset classes in all the different sectors and focus on high quality stocks. And what do I mean by high quality? Strong balance sheets, good cash flow, companies that can maintain their margins, don't have too much debt, and whose prices are not outrageous. Look at the price earnings multiples. Look at the price to sales. You don't want to pay too much, because what you pay for something really has a big determining factor in what your long-term future return is going to be. So buy good quality stuff and don't pay too much for it. Makes sense, right? Let's see. So, be patient. Again, nobody really knows. The Fed doesn't know. And all the prognosticators and talking heads on the TV are making guesses. They don't know. And we'll have to kind of watch the data and see what happens. So with that, why don't we just kind of open it up for questions and comments? Who's going to be first?
Kenneth, you had your hand up for a little bit. Go ahead. You're on mute.
You're on mute, Ken. Ken, you're on mute.
I think he's reaching for it.
Oh,
Yeah,
okay.
better?
There you go. We
I
got
can
it.
hear you.
Sorry, guys. I always thought the reduction of printing money was the way to reduce inflation.
No, if you print money, it creates inflation.
That's right. That's what I meant to say.
Yeah.
I thought you said the opposite.
Well, no, remember in 20 and 21, they printed, the money supply increased 42%. That really was the primary contributor of inflation.
Yes.
Now, in the past year, the money supply has actually decreased by 4.6%, which should slow the economy down. Okay.
I just thought you said the opposite. That's all.
No,
Sorry.
no problem. Who's next?
Irv, you had your hand up. Go ahead. You're on mute, though. You should get a prompt to unmute.
Oh, can you hear me now?
Yep.
Yep. Go ahead.
Okay. Out here, I live off of Olive out in Chesterfield, and from the Interstate 64 going down towards Woods Mill, the state, I guess this is infrastructure money, is tearing out the old sidewalks and putting in new, and they're putting in sidewalks where there weren't any before. And it just boggles my mind. This has got to be a big money project. And I guess they're looking for ways to spend that infrastructure money. I guess that helps the economy, putting money into circulation. But we got the nicest sidewalks you'd want to look at, and they're still working. The eastbound are done, and now they're coming west on the other side of Olive. And occasionally you see a runner or maybe a walker, but nobody's really hardly ever using those sidewalks. Just occasional people that run or walk their dog.
Thanks, Irv. Yeah, Mike. So, was the infrastructure a good driver for the economy?
It will be. The money hasn't been spent yet, because remember, it takes. Think about it. You have to go through all those permitting process, so it takes a while to get a big infrastructure process done. Part of what was agreed to as part of this debt ceiling discussion and arrangement was to try to speed up the permitting process so more of these projects can get done more quickly. But it takes 2 to 3 years to get a big infrastructure project through all the approval process. So the sidewalks that Irv is seeing really isn't a result of the new infrastructure bill from last year. That's from some of the stimulus money from 20 and 21. So there's more to come. A lot more to come. A lot more.
I've heard they're also going to resurface Olive. I could see that being needed more than sidewalks, but
Yeah, that's more at the city level. So anyway, you're gonna see a lot more, a lot more highway approvals, bridge approvals. There's gonna be a lot of stuff that's gonna be happening in next, as this is spread out over 10 years too, guys. So,
All right.
but
Thanks,
it
sir.
takes a while to get these big projects done.
I've seen other construction, I guess you might probably all have, and I've seen sidewalks being replaced in other areas also, and roads.
Okay, who else has a question?
Thank you, Irv. So we'll have to jump to the next question because Marilyn has her hand up. So Marilyn, go ahead.
Okay. It seems everything you read in the paper is AI. And I was just wondering, do you think that will play a big part in remaking the economy? Number one.
Yes.
And number two, what stocks, it's a leading question, would you recommend? Tech stocks to buy now that are the most profitable, or that's
There have been 7 stocks have been the primary drivers of this AI boom. NVIDIA being one, Microsoft, Alphabet. Those big tech stocks are the ones that everybody kind of expects will be the drivers of this AI boom. But Oracle's another one just reported recently. Okay, the big tech stock, but remember their prices have run up a lot already. They are not cheap. So, you can watch those. They're expected to be the drivers, but you might want to wait till they come in a little bit because they run up a lot really quickly. And again, remember, you don't want to pay too much. Okay. But those are the stocks that everybody kind of thinks will be the big beneficiaries and drivers of this AI boom and AI over time. And again, I'm not a technology expert. Okay. But the implication is that this is going to be a big deal, and it's going to make our economy run more efficiently and make our lives better, and will make workers more productive, which is potentially going to add more profits to the companies and help stock prices. We will see.
Mhm. Thank you.
You have
All
a
right, thanks,
question?
Marilyn. So we have a little bit of a queue. So Ernie, we'll have you next, then Sheldon, and then Kenneth.
Okay.
Okay, we're spending money, but I heard on the news broadcast this morning that our Eastern Airport over in Illinois was opening the expansion, and a lot of money must have gone into that. Are we spending money where there's a demand? I don't know of the demand for the airport over in Illinois. How many flights are going in and out of there? We might have one carrier over there, but why are we expanding the airport in Illinois when I don't think there's really a demand over there?
I think that's more of a political question than an economic. Your question's a good one, Ernie. It's a good question. But things like airports and highways and roads and ports as part of infrastructure, clearly, I think there's a lot of planned expansion at the Lambert Airport here as well.
We're gonna not only expand it, we're gonna redo it, like tear it down, redo it.
Well,
and start over again.
That airport was built when, in the 1950s?
Yeah,
It's really dated.
it's dated, but the demand is decreasing, even though they're saying it's increasing. But where's the demand? Let's spend money where there's a demand instead of foolishly spending money.
Yeah, air travel is really very strong. I guess everybody's traveling. That's part of the service sector economy. And I think that you just raised a good point. The ISM numbers, the Purchasing Managers Index numbers, have been declining the last several months, which kind of helps supports the bear case. The manufacturing purchasing managers numbers are at 46.9%. Anything below 50 is contraction. So the manufacturing sector of our economy is contracting. And the service sector economy, their PMI number came in at 50.3 this past month. And that's declined from 55 at the beginning of the year. So even the service sector of the economy is starting to slow down. And that's 70% of our economy. But it gets to your point, Ernie, is that, people are traveling, but they're starting to travel less.
But they're traveling less because it's harder to travel because there's nobody in the service industry any longer. because you can't get service.
Are you trying to say nobody wants to work?
I think people want to work, but their level of participation for their return monetarily seems to have increased.
I understand. That's a good point.
Thanks, Ernie. Go ahead, Sheldon.
Yes, I want to go back to Maryland's inquiry, and particularly with respect to artificial intelligence, because if there's a particular segment of our economy where there seems to be a high level of interest, tremendous growth potential, that might be it. And yes, the large companies have already benefited a lot in terms of prices, market price. But there's one company I'd like to ask you about in terms of that doesn't seem to have yet enjoyed the artificial intelligence takeoff. It's probably been one of the founders of that whole arena, and that's Intel. I'm interested in your thoughts on Intel. What's wrong? Why is it lagging behind the rest of the market when it was really one of the leaders in artificial intelligence?
And that's a company that's really lost its way. It was the largest. It got a little complacent, okay, and others caught up to it and surpassed it in terms of their technical capabilities. Companies like AMD and Qualcomm and others at Marvell have built far superior chips than AI. Their management got complacent. They had quality issues in producing quality chips, and a lot of their customers went to other manufacturers for chips. Now they've got a new leader there. Pat Gelsinger is trying to turn the company around, and they're building. As part of the CHIPS Act, they're building new facilities in Ohio to try and improve their foundries so they can make quality chips again. But
they just acquired
basically a company's management got complacent, they lost their edge, and competitors caught up. And
they just acquired a major company in Israel. Intel did, and is integrating some of that Israeli management into the senior ranks.
Well, let's hope it helps them. But that's what happens when you get complacent. You get too big, you had a huge market share, you get complacent, you lose your edge. And in the technology business, technology, as we all know, changes really quickly. It was it Moore's law that every 6 months the technology just completely changed? We all know this, okay? As soon as we learn how to use a device or an app or something, they change it, because and we have to learn it all over again. But technology changes quickly, and you have to move quick and keep up. If you don't, you lose your edge. Your competitors pass you. That's what's happened to Intel, unfortunately.
Thank you.
Hopefully they can turn it around, but we'll see.
All right, thank you. Ken, you had your hand up a little bit ago.
Yeah, I did. Thank you. I have a grandson, 21-year-old grandson that's an intern at John Hancock Wealth in Phoenix. And he's been there about a week, so but he tells me that there is 2 million, almost 3 trillion, 2 trillion 9, almost $3 trillion dollars on the sideline now, waiting to go into the market. Is that true?
Well, remember, interest rates are a lot higher than they used to be. In money market funds and our bank accounts, we used to get paid how much?
3 or 4%.
0. Today, you can get 4.5%, 5%. So there is a lot of money sitting in money market funds, okay? And if the fog cleared, okay, and we had a clearer picture of what was going to happen in the economy and the markets, I suspect a lot of that money might start moving into the markets and drive prices up.
What event would make that happen, or what sequence of events would make that happen?
If we had a soft landing, we didn't have the recession that the bears think, okay, and that $246 earnings estimate for 2024 turns out to be close to realistic, that would help. But again, we have to kind of wait. We have to see. Nobody knows for sure, and the data supports both the bull and the bear case. So there's a lot of money. And at 4.5% to 5%, the money can afford to sit there for a while till the fog clears a little bit. It'll never clear it completely, because there's always something to worry about in the economy and the markets. But always, okay, always think about our history going back. There's always something to worry about. You're never going to know for sure, but you'll have more clarity, I suspect, as the data comes in over the next few months, and we see what the impact of the Fed rate increases have been, and if indeed they need to do more, which they could.
Well, thank you for that very clear explanation.
Okay, so we have a little bit of the queue again. So next we'll have Gary, then Steve, and then Norman. So go ahead, Gary.
Yes, thank you. And thanks, Mike, for your overview. This is the first time I've joined your session, and I've enjoyed it. My question is about the two economic acts during the Biden administration, the CHIPS Act and the Inflation Reduction Act, and what pressures it's putting on the economy, whether that we can fulfill the requirements of these acts. In other words, producing the component parts to make these EV vehicles and so forth. What is your opinion of these two acts, and whether they need to be modified in such a way to really make a difference?
Well, again, they could provide a lot of stimulus, okay, to help the economy grow. And especially with regard to the electrification of the US EVs. I mean, the kind of material that we need to build the electronic vehicles doesn't currently exist. Okay. For example, copper, lithium, nickel, cobalt. There's a big world shortage of that stuff. And guess where a lot of it's produced? China, exactly right. So obviously, some of this money has got to be directed towards building up that infrastructure to get the basic raw materials to do all this, and streamlining the permitting process so that the stuff can happen. Okay, if you want to produce lithium, then you have to allow mining. If you want more copper, you have to allow mining. If you want more nickel and cobalt, you got to allow mining, which is environmentally not produced in the most efficient way. So we really got to think about how we do this and how long it takes to get this stuff ready so that it can be produced to support this new electrification process. Permitting is important too. You got to streamline that permitting process to get this done. And then you got to have a transition plan. Yeah, you can't go from 0 to 100 overnight. You got to have transition plans and things like, allowing for more nuclear, more use of natural gas during the transition to electronics has to be more fully thought through. So that would be my thoughts on it. Again, I'm not an expert in this stuff, but just kind of thinking about what's going to be needed to accomplish what they want to be able to do and where we are today. There's a lot that has to be done between now and 2030, 2040. The estimate is we still won't be, 20 or 30% electric by 2050 because of the need for all the basic raw materials to get stuff done, regardless of what their objective is. It's going to take a lot of time to transition to where they want to go, and a lot of work's got to be done to develop the raw materials, to streamline the permitting process, and to provide for transition fuels during the process. But I don't have an opinion on it. No. There's a lot that needs to be done, Gary. That's a very good question.
All these minerals that are in that China has, are they from China itself, or are they from the Belt program, where China takes them from countries like Africa?
Well, that Belt and Road policy that China's pursuing, it's to try to spread their influence around the world. Okay, so that hopefully in their mind someday they can supplant the US as the primary economic power in the world. But that's kind of their objective with their Belt and Road strategy. But remember, China has its own issues it's dealing with. Okay, its economy is not growing very fast. They've borrowed a lot of money. Okay, they have a lot of debt and they have their own economic problems with real estate and, declining population, et cetera. So, that's what I think of that.
Steve, go ahead.
Yeah, hi, thanks for a great talk. I recently tried Chat GPT myself to see how it works. It is the most amazing thing that I ever saw. I put in one word because I was working on a case on bullying, and it printed out the most beautiful essay I have ever seen. I wish I was in school now. I wouldn't have. I feel, but you have to take a chance that there are programs out now that can catch the students trying to use that to write their essays. And I know that I have a property manager downstairs. Several of the baseball players got caught at their school trying to write essays using ChatGPT. but I have never seen anything as amazing as what that can do. It was truly amazing. I've noticed that, the S&P, as you said, is up about 10% so far this year. And the NASDAQ is actually up 24%.
Right, it's all those big tech stocks.
All the big tech stocks. In fact, it was up 6% last month. Yet the Dow was down 3% last month. And it's only up about 0.25%, less than 1% for the year. And as you said, it's only 7 stocks. Like NVIDIA is up, it was up 160, 170% so far.
Right.
It's huge. I mean, and Google and Amazon are up 40, 50%. Just 7 stocks, as you said, is carrying this entire market. So most people have not made any money in the market, even though
You're right. You're right.
Most people probably have lost money in the market if you're in other stocks. So
if you kind of, Steve, just at that point, 60% of the stocks in the S&P 500 through today, or excuse me, through the end of last week were up, 40% were down. Okay. Yeah. But the biggest ones that were up are the big tech stocks, as you mentioned.
Yeah, and they're carrying the whole market. So I'm not sure how much longer they can carry this market.
Well, the market has to broaden out if the rally is sustainable and if the bull case is to hold water. Again, a lot of it's data dependent.
And well, the other thing is we were talking about Intel. Just in the last 2 or 3 days, I've seen a significant, a pretty significant rise just in the last 2 or 3 days. And we put billions and billions of dollars into this CHIP Act. I think it's a long-term proposition. Intel's probably no more now than it was 20 or 30 years ago. I mean, it hasn't moved a whole lot.
It's not done well.
Has not done well. And it's going to take a while if this new factory in Ohio is built. It might take another 2 or 3 years, but they're going to have to come up with new chips and be able to compete with the NVIDIAs and the other stocks. The other stocks that have really increased a lot, just some of them up maybe 1,000%, is lithium stocks. Just right. A tremendous increase in lithium stocks. Some of them are up 1,000% just in the last couple months. The problem is that China owns a whole lot of this, maybe 90%. And if we would ever get into a war with China, we can't survive because they control 90% of the rare earths. So we have a real problem there with China. If they would get into a war with us, so that they could cut off our things. There was an article in the front page of the Wall Street about a week ago showing that mining for all of these minerals is more destructive to the environment than oil and gas, because it's a very dirty business trying to dig up all of these elements. And so when we talk about doing things for the environment, all these batteries that we have to produce is not environmentally friendly. And they're saying, I've heard Carl Bender say it's more destructive to the economy, to the environment than that. So
Okay, thank you,
no
Steve. We'll have to
problem.
jump to the next question because we got a bit of a queue. Norman, go ahead.
Yes, I have a question related to investment objective strategy. Some of the talking heads that I see on the investment shows that I respect have indicated that in the next couple of years, we will do better with putting our money internationally than we will in the US. And I was wondering if you had an opinion about that.
If you look at valuations of stocks overseas, they usually trade at a discount to US stocks. But the margin of discount recently is much wider than it has been historically. So a number of strategists look at international stocks as being cheap relative to the US. Remember here, the forward PE on the US and the S&P 500 is at 19.5. And that's way above the historical average of 15 and a half. Foreign stocks are probably trading at a much wider discount to US stocks than they have historically. That's why they're saying that, Norman. Okay. But you know what? They've been saying that for the last 10 or 12 years.
Hasn't worked yet, so.
At some point it probably will, but you have to listen to that and you know, as appropriate, because they've been saying it, these stocks have been trading at a big discount to US stocks for a very long time, and there are reasons why. Okay, we're the best house on a bad street. We have the most resilient economy and the most dynamic economy in the world. Okay, and we have the most amount of innovation and creativity in the world. That's why our stock market is valued a lot higher than others. Plus, we have a lot of other things going on, okay, in terms of rule of law, in terms of deep capital markets, et cetera, and the dollar is the reserve currency of the world. So there's a lot of reasons why the US stock market has a higher valuation than other stocks around the world. But the discount that they have, the international stocks have been trading relative to the US is at one of the widest discounts it's been in many years. So there could be maybe some outsized upside potential there as well. But again, be careful about how much you put international. You know, 20 to 25% is probably a reasonable number. Don't go overboard with it. Remember, you still pay your bills in dollars. So stay concentrated in your investment portfolio in US assets.
Okay.
Thanks, Norman. John, go ahead and
You're on mute, John.
Hello, yes,
Hello.
hi. Thanks a lot for your wise comments. Regarding my pet peeve is the stock buybacks and lack of repatriation of funds, which the government has been trying for years to penalize companies for stock buybacks versus investing it in the economy or investing in infrastructure, modernizing their plants and equipment. The Rust Belt is rusty because they haven't done anything to improve it. So we have to go overseas, China, et cetera. And it doesn't seem like any of these activities that the government or Congress have participated in or try to bring back the foreign funds or to stop buybacks. I see that Warren Buffett says that one of the big reasons that Berkshire Hathaway has grown is because of the stock buybacks. So do you have some comments, and you think this will ever change?
Again, companies are trying to provide a return to their investors. They can do that several different ways. They could buy back their stock if they think it's cheap, okay, and reduce the number of shares outstanding, and they can pay dividends. Stock buybacks aren't taxed, okay, but dividends are. And that's why a lot of companies have devoted a lot of their return of cash to investors in the terms of stock buybacks. The key thing is, are they paying too much for the stock they're buying back? You have to buy the stock when it's cheap. You don't want to buy back Nvidia stock when it's at an all-time high, trading at 20 times sales. Okay. So the businesses have to look at, what's the most efficient way to return capital to shareholders. If you can reduce the share count, then the share price can go up because you have fewer shares for the same amount of earnings. So that makes sense from a providing return to investors point of view, as opposed to paying dividends, which are taxed.
Yes, and corporations have a lot of them have huge cash reserves.
Right.
That they're not using to reinvest in their facilities.
Well, it depends. Some, okay. You have companies like Apple have a huge cash reserve, but they're expanding their business and they're adding new products all the time, and they're doing a lot of R&D with it. But again, they're doing a lot of stock buybacks too, if the price is right, and paying a dividend. But other companies too, again, it's what's the most efficient way to return capital to investors. If they're doing their job right, they look at that very carefully. They buy back stock when the price is right. Are they diverted and pay dividends?
Is there any way one would know when they're buying back stock?
Oh, sure, they have to disclose that. That has to be approved by their board of directors. I mean, you can go to any company's website and read their earnings releases and look at the conference call data. It's all there. It's all publicly disclosed.
So Mike, wait, we got Irv. Go ahead. You got a question?
Oh, I know we're in a global economy, and I was in Dearborn last week looking at some patriotic stuff that they had, decorative, I guess, for the 4th of July. And they had, I put out flags for the holidays and, different patriotic stuff. And I picked up a flag, it looked like it was made out of plastic, and I was just about to go ahead and buy it. And I looked at the tag to see the price. The bottom of the tag, it says made in China. And to buy an American flag that's made in China, I dropped that thing like it was a hot potato. I wouldn't take it if they gave it to me to take out the store for no cost. It's just, and they had several things. That I would venture to say they're probably the majority of them, if not all of them, are made in China. And it was different, flags and pinwheels and red, white, and blue decorative stuff.
Well, Irv, you raise an interesting point. Okay, the Chinese economy is so integrated with the rest of the world in terms of trade. Any confrontation on a military basis would be disruptive to everybody, and it's in nobody's interest that happen. Not in our interest, not the Chinese interests. And yeah, I hear a lot of bluster, but I just can't see something happening where all the economies are so, as you say, it's global and it's all highly integrated.
Okay, Marilyn, you had your hand up, and then Sheldon, you'll be next.
Okay.
There's probably not much you can say, but my main objection is when the big bank, SVB, and others went under, the CEO received, before it went under, a huge compensation, sold all of his stock, and you know he knew what was going on. And when Elizabeth Warren asked him the question, Becker, I think his name was, I'm not sure, if he would pay the money back. Maybe a stupid question or whatever. And of course he said no, but I mean, what do you think about, I mean, it's money and greed. That's the bottom line.
And remember, the management of the company is supposed to run the companies for the benefit of the investors. Mm-hmm. You're right. There is a lot of abuses that go on that shouldn't. But the board of directors is there to try to represent the investors to control this stuff. It sounds like people weren't doing their job.
Right. Welcome to the real world, right?
Amen.
Thanks,
Thank
Marilyn.
you.
Sheldon, go ahead.
Yes, two unrelated points I'd like to make. One piggybacks on the comment that you just made in terms of management is supposed to execute policies and strategies that will maximize shareholder value. You don't do that, and the shareholders are going to throw you out. The board of directors is going to throw you out. So if the company has excess cash and it can take stock out of the market, thereby increasing earnings per share, therefore ultimately increasing the values of those shares, that's a damn good strategy. And I don't see anything wrong with executing that strategy or being negative about buying back shares. I just think it's a misnomer that many people are jumping on. Second point I'd like to make, and that is the increase in value in technology. What else is growing in this country? What other industries are growing other than technology? Healthcare, maybe. But other than that, most of the industries in this country most industries in this country have been, for at least the last 5 years, pretty moderate and soft in terms of growth. So yes, which investors are chasing growth. And where else is it? It's in technology. So it seems like a very logical thing.
No, you're right, Sheldon. But also too, if the economy is slow and we have the soft landing, some of these cyclical stocks, which have really been beaten down, can really have a huge move in their share prices as the economy gets roaring again. So you can still make a lot of money on cyclical stocks and industrial stocks and other stocks that tend to be very cyclical when you buy them at the bottom. Don't ask me exactly where that is.
If you can identify the bottom. And you got to be patient.
You got to be patient.
It could take a long time.
You can make money in other stocks and other sectors in the economy, but they're all different, and you got to time your purchases at different times. Okay, and you got to do your homework. You got to do your homework.
Technology is ongoing. It's year after year. It's growth.
You're right, Sheldon, but the danger is that technology changes fast, and if you can invest in technology, a company like Intel, and make money for a period of time, but if management takes its eye off the ball, what happens?
Yeah, right.
You get clobbered.
You can say the same about IBM.
You could say the thing. IBM is doing better, fortunately. A little better.
A little
better.
Little. Yeah.
Pays a nice dividend, though.
You know, Mike, I have a question. So is it, you know how like in the 90s there was like that .com bubble,
right?
At first, could that be
Sure.
any
AI is
similarities between what's going on now?
the new internet. Artificial intelligence is the new internet. It's the new cloud. It's the new internet.
Yeah.
And there's always going to be something that's new, which is great. That's a dynamic economy. Okay, that's the kind of economy you want to invest in. But there's always something, Daniel. There are things that are going to, the next 5 or 10 years, we're going to hear and see about things we know nothing about, and that's great. That's wonderful. That's wonderful. That's the kind of one of the place you want to live and want to invest. Okay, you want a creative, dynamic economy, and the U.S. is the most creative, dynamic economy in the world. Despite all of our issues and problems, it's still the best place to live and the best place to invest.
Okay, I like that. It's a really positive note to end on.
It's the best house on a bad street.
I like that. It's a really positive note to end on. Mike, that was an incredible talk. Again,
I'll hang around. If folks want to hang around longer and talk, I'm more than willing to do that. So if anybody wants to drop off. If you want to stay on and talk some more, again, this is a discussion. So if you have opinions, speak up. Okay, we want to hear what you have to say.
Okay, I will have to jump out in a few minutes because I've got to set up for, we have a Rabbi
Oh,
Mason
in that case, forget what I just said.
coming in, but I think Irv's got a closing comment. So Irv, go ahead.
See you guys.
Oh, he wants to say bye.
All right, take care, everyone. See
All
you
right,
next
guys.
time.
See you
Again,
next
Mike,
time.
Thank you very much.
Bye-bye.
That was fantastic.
Thank you very much. Very
Thank
interesting.
you.
Bye, guys.